Imagine waking up one morning and realizing that your income no longer depends on whether you go to work that day. Your phone buzzes not with reminders from your boss, but with notifications that money has just been deposited into your account. You didn't sell anything. You didn't clock in. You didn't tea. For most people, that idea sounds like something reserved for the wealthy or the extremely lucky. But the truth is much more interesting than that. Financial independence doesn't usually happen all at once. It's built slowly, piece by piece, through a system that allows Y, and one of the simplest systems ever created, F.
Dividends are one of the most powerful tools available to everyday investors. They transform stocks from something you hope will rise in price into something that actually pays you cash along the way.
Instead of waiting years to sell your investments, you can begin collecting. Now, imagine what that coal. Picture building a portfolio designed to generate around $4,000 every single month. That's $48,000 a year, arriving without the need to sell your investments or rely on a paycheck. For many people, that amount alone could cover housing, groceries, transportation, and a large portion of everyday living expenses. But here's where things get interesting. There isn't just think of it like choosing a route on a long journey. In this video, we're going to explore 3 completely different strategies that can all potentially lead to that $4,000 per month income target. The first strategy focuses on stability and long-term growth. It's built around some of the most reliable dividend-paying companies in the market, businesses that have increased their dividends for decades. This path takes patience, but it offers remarkable consistency.
The second strategy moves a little faster by using real estate investment trusts, also known as REITs. These investments generate income from properties like warehouses, offices, and advertising spaces.
Because of the cash flow real estate produces, they tend to pay higher dividends than many traditional stocks. And the third strategy is designed to accelerate income even further using covered call ETFs. These funds are built specifically to generate high monthly income, which can dramatically shorten the timeline to reaching that $4,000 goal. Each approach has its own trade-offs. One prioritizes stability, one balances growth with income, and one focuses heavily on generating cash flow as quickly as possible. But before we dive into those strategies, we need to slow down for a moment and understand something fundamental. Because if you truly understand this one concept, the rest of the strategy becomes much easier to see. What exactly is a dividend, and why do companies pay them in the first place? Once that foundation becomes clear, the entire system of building passive income starts to make much more sense. And you'll begin to see how even small amounts of money invested consistently can grow into something surprisingly powerful over time. Before we talk about strategies, portfolios, or timelines, we need to understand the foundation that makes all of this possible. Because once you truly understand how dividends work, the idea of building income from investments becomes far less mysterious and far more practical. At its core, investing in stocks simply means owning a small piece of a real business. When you buy shares of a company, you're not just buying numbers on a screen. You're becoming a partial owner of that company. If that company sells products, earns profits, and grows over time, you participate in that success. Now, here's where dividends enter the picture. When a company earns profits, it has several choices about what to do with that money. It can reinvest the profits back into the business to expand operations, develop new products, or enter new markets. That's how many fast-growing companies operate. But some companies, especially mature and well-established ones, generate more profit than they need for expansion. When that happens, management may decide to share part of those profits with the shareholders who own the company. That payment is called a dividend. In simple terms, dividends are cash payments companies distribute to their investors as a share of the company's profits. If you own the stock, you receive a portion of those payments based on how many shares you hold. Imagine a company that earns billions of dollars each year and decides to distribute a part of that income to its investors. Every quarter, money flows from the company's profits directly into shareholders' accounts. The more shares you own, the larger that payment becomes. And Here's one of the most powerful parts of dividend investing. Those payments can grow over time.
Many companies gradually increase their dividend payments year after year as their profits expand. This means an investor who owns those shares can receive higher income without buying additional stock.
The company itself is effectively giving investors a raise. To help investors compare different dividend-paying investments, there's an important metric called dividend yield. Dividend yield tells you how much income an investment produces relative to its current price. It's usually expressed as a percentage. For example, imagine a stock priced at $100 per share that pays $5 per year in dividends. That would represent a 5% dividend yield. If you invested $10,000 into that stock, you would receive approximately $500 per year in dividend income. Now, here's where strategy becomes important. Some investments offer relatively low dividend yields, perhaps 2% or 3%. These companies often grow quickly, meaning the stock price and dividend payments increase steadily over time. Other investments offer much higher yields, sometimes 7%, 8%, or even above 10%. These generate more income immediately, but may grow more slowly or carry additional risks. This creates the fundamental trade-off in dividend investing. Lower yields typically provide stronger long-term growth and stability. Higher yields provide faster income, but sometimes with less price appreciation or greater volatility. There is no single perfect choice. Instead, investors decide which balance between income, growth, and risk best fits their goals. And this is exactly what John is trying to figure out. His goal is simple. He wants to build a portfolio capable of generating about $4,000 per month in dividend income. But the path he takes to reach that goal can look very different depending on which types of investments he chooses. Some paths require more time but less risk. Others reach the goal much faster but involve greater uncertainty along the way. Now that we understand how dividends work and how yield affects income potential, we can begin exploring the first strategy, the one built for stability and long-term growth. This approach focuses on a special group of companies known for something extremely rare in the investing world: decades of consistently increasing dividend payments. And these companies are known as dividend aristocrats. Now that the foundation is clear, we can begin looking at the first path John could take to reach his $4,000 per month income goal. The strategy focuses on stability above all else. It may not be the fastest route, but it is built around companies that have demonstrated remarkable resilience over long periods of time. These companies belong to a special group known as dividend aristocrats. Dividend aristocrats are businesses that have increased their dividend payments every single year for at least 25 consecutive years. Think about what that really means. Over those decades, the economy has experienced recessions, market crashes, inflation spikes, and global financial crises. Yet these companies still found ways to grow their profits and reward their shareholders with higher income year after year. That kind of consistency doesn't happen by accident. It usually means the company has strong leadership, durable business models, and products or services people continue to buy even during difficult economic times. For John, building a dividend aristocrat portfolio means focusing on reliable companies that can steadily grow both income and portfolio value over time. Instead of chasing extremely high yields, this strategy relies on the combination of moderate dividend income and strong long-term growth. To illustrate how this works, imagine John building a portfolio using 3 high-quality dividend-focused holdings that complement each other. The first company in this strategy is Lowe's Companies. Lowe's is one of the largest home improvement retailers in the world. It sells everything from tools and appliances to construction materials. Because housing and home maintenance are long-term necessities, companies like Lowe's often produce stable revenue even during economic uncertainty. Currently, Lowe's offers a dividend yield of around 1.7%. At first glance, that might seem small compared to other dividend investments. But the real strength of Lowe's lies in its dividend growth. Over the past decade, Lowe's has increased its dividend payments at an average annual rate of more than 16%. At the same time, the company's share price has grown strongly. compounding investor wealth year after year. The second holding adds another layer of stability through the utility and energy sector, NextEra Energy. NextEra is one of the largest producers of renewable energy in the United States. Utilities are often considered some of the most stable businesses in the market because electricity and energy are essential services. People need power regardless of economic conditions. NextEra currently offers a dividend yield around 2.6%, with dividend growth averaging roughly 11% annually over the past decade. In addition to this income growth, its share price has appreciated steadily as the demand for clean energy continues to expand. The third piece of John's portfolio is the Schwab US Dividend Equity ETF, commonly known by its ticker symbol SCHD. Instead of investing in a single company, SCHD spreads John's investment across dozens of strong dividend-paying businesses from many different industries. This diversification helps reduce risk while still providing reliable income. SCHD currently offers a dividend yield of roughly 3.6%, along with consistent dividend growth and long-term price appreciation. Because it includes companies across sectors such as healthcare, industrials, consumer goods, and financials, it adds stability to the overall portfolio. When these three investments are combined, the portfolio creates a balanced system. It produces moderate income today while allowing dividends and share prices to grow over time. On average, this portfolio produces a dividend yield of about 2.6%. Dividend income grows roughly 12% per year, while the value of the investments themselves appreciates around 12% annually as well. But this raises an important question. How much money would John actually need invested to generate $4,000 per month right away? At a yield of 2.6%, producing $48,000 per year in dividend income would require roughly $1.8 million invested from the beginning. That number may sound intimidating, and for most people it isn't realistic to start with that level of capital. Instead, John takes a more practical approach. He begins with an initial investment of $20,000 and commits to investing $10 per day going forward. That adds up to about $3,650 per year in new contributions. Every dividend payment he receives is reinvested back into the portfolio, allowing compound growth to take effect. Over time, something remarkable begins to happen. In the early years, the progress feels slow, but as the portfolio grows and dividends are reinvested, the compounding effect becomes stronger each year. Eventually, the income snowball begins rolling faster and faster. And while this strategy may take longer than the others, it creates a powerful foundation of stable businesses that continue rewarding investors decade after decade. But what if John wanted to accelerate the process? What if he was willing to accept a little more risk in exchange for stronger income earlier in the journey? That's where the second strategy comes in, one that moves beyond traditional dividend stocks and into the world of real estate income. Now let's move to the second path John could take to reach that same $4,000 per month income goal. This strategy sits right in the middle between safety and speed. It still focuses on income-producing assets, but the cash flow arrives faster than with traditional dividend stocks. This is where REITs come into the picture. REIT stands for Real Estate Investment Trust. Instead of owning one physical property like a house or an apartment building, investors in REITs own shares of companies that manage large portfolios of real estate. These companies collect rent from properties such as warehouses, office buildings, shopping centers, and advertising structures. That rental income becomes the foundation for the dividends investors receive. What makes REITs unique is the structure they operate under. In order to maintain their special tax status, most REITs are required to distribute at least 90% of their taxable income back to shareholders. Because of this rule, REITs often pay significantly higher dividends than many traditional stocks. For someone like John who wants to increase his income potential sooner, this higher payout can make a noticeable difference. To build this middle risk strategy, John focuses on three different REITs that each contribute something slightly different to the portfolio. The first is Prologis.
one of the largest logistics real estate companies in the world. Prologis owns massive warehouse and distribution facilities that support global supply chains.
These properties are used by companies that move goods across the country and around the world.
As online shopping continues growing, the demand for logistics and distribution centers has increased dramatically. Because of this, Prologis has experienced steady growth in both rental income and property value.
The company currently offers a dividend yield around 3.1%, with dividend growth averaging over 10% annually during the past decade. Its share price has also appreciated steadily as the logistics sector continues expanding. The second REIT in the portfolio is CTO Realty Growth. This company plays a very different role in the strategy. While Prologis focuses on long-term stability and growth, CTO provides significantly higher income. CTO currently offers a dividend yield above 8%, making it one of the higher income-generating positions in the portfolio. Over the past decade, its dividend growth has averaged more than 19% per year. However, the trade-off is that its share price growth has been slower compared to companies like Prologis. This combination of higher yield and slower price growth helps boost the overall income of the portfolio. The third REIT is Lamar Advertising. Unlike most real estate companies, Lamar owns thousands of billboards and outdoor advertising structures across the United States. Businesses rent these spaces to promote their products, creating a steady stream of rental income.
Lamar currently offers a dividend yield around 5%. Its dividend growth rate has averaged close to 8% annually, while its share price has appreciated steadily over time.
Adding Lamar introduces another layer of diversification to the portfolio, since advertising real estate behaves differently from logistics or retail properties. When these three REITs are combined, John's portfolio produces an average dividend yield of roughly 5.5%. Dividend income grows around 12% per year, while the share prices themselves appreciate at a more moderate pace. Compared to the Dividend Aristocrat strategy we discussed earlier, this approach significantly increases the amount of income generated per dollar invested. So how much capital would be required to produce $4,000 per month immediately using this strategy? At a yield of about 5.5%, generating $48,000 per year in dividend income would require approximately $868,000 invested up front. That is still a substantial amount of money, but it is less than half of the capital required for the Dividend Aristocrat portfolio. Of course, John isn't starting with nearly that much. Instead, he follows the same disciplined investment plan as before. He begins with $20,000 and continues investing $10 per day while reinvesting every dividend payment. Because his portfolio produces higher income earlier, the compounding process accelerates compared to the previous strategy. Over time, the portfolio grows steadily through both reinvested dividends and moderate price appreciation. Eventually, the income stream becomes strong enough to reach John's target. Under these assumptions, the portfolio could potentially reach the $4,000 monthly income level in about 17 years. That's roughly 10 years faster than the Dividend Aristocrat strategy. But there's still one more path to explore. What if John wanted to push the income curve even higher? What if the primary goal was to generate cash flow as quickly as possible, even if that meant sacrificing some long-term price growth? That's where the final strategy comes in, and it revolves around a group of investments specifically designed for one purpose: maximizing income. Now we arrive at the final strategy, the one built specifically for investors who want to generate income as quickly as possible.
This approach focuses less on long-term price growth and more on turning capital into cash flow at the fastest possible rate.
The investments used here are known as covered call ETFs. To understand why these funds can produce such high income, we need to look at how they actually generate money. Traditional dividend stocks rely mostly on company profits. If a company earns more money, it can increase the dividends it pays to shareholders. Covered call ETFs work a little differently because they create an additional source of income through options. Here's the simplified version. These ETFs own portfolios of stocks, often large companies like those in the S&P 500 or the NASDAQ. But instead of simply holding those stocks and collecting dividends, the fund managers also sell call options on those holdings. A call option gives another investor the right, but not the obligation, to buy a stock at a predetermined price within a certain period of time. When someone purchases that option, they pay a premium up front. That premium becomes income for the ETF. Whether the option is exercised or not, the ETF keeps that payment. Over time, these option premiums can add up to a substantial stream of cash flow. That extra income is then distributed to investors in the form of higher dividend payments. Of course, there is a trade-off. Because the ETF agrees to sell stocks at predetermined prices, its ability to fully capture strong market rallies becomes limited. In other words, covered call strategies often sacrifice some potential price growth in exchange for significantly higher income today. For John, this strategy represents the fastest way to convert invested capital into monthly cash flow. To build this high-income portfolio, he selects 3 covered call ETFs. The first is the J.P. Morgan NASDAQ Equity Premium Income ETF, commonly known by its ticker symbol JEPQ. This fund focuses primarily on large technology companies from the NASDAQ index while layering covered call strategies on top. JEPQ currently produces a dividend yield of around 10%. That level of income is dramatically higher than most traditional dividend stocks. In addition to the high yield, the fund has also shown modest price appreciation over time as the underlying technology companies continue growing. The second ETF in this portfolio is the Invesco S&P 500 Buy Right ETF, ticker PBP. This fund applies a covered call strategy directly to companies within the S&P 500. By consistently selling options against these holdings, the ETF generates a steady stream of option premium income. PBP produces an even higher yield, often exceeding 11%. However, because of the covered call strategy, the share price tends to grow more slowly compared to the broader stock market. The third component is the Global X S&P 500 Covered Call ETF, known by the ticker XYLD. Like PBP, this fund generates income by writing call options on stocks from the S&P 500 index. Its dividend yield typically stays above 10%, making it another powerful income generator within the portfolio. When these 3 funds are combined, the resulting portfolio produces an average dividend yield of roughly 10.6%. Dividend growth averages around 15% annually, while share price appreciation tends to be more limited compared to traditional stocks. But the real advantage of this strategy becomes clear when we look at the income potential. At a yield of approximately 10.6%, generating $48,000 per year in dividend income would require about $450,000 invested up front, compared to the nearly $1.8 million required for the Dividend Aristocrat strategy. This is a dramatically lower capital requirement. Once again, John follows the same disciplined investment plan. He begins with $20,000 and continues adding $10 per day while reinvesting every dividend payment along the way. Because the portfolio produces such high income early on, the compounding effect accelerates rapidly. In this scenario, the portfolio could potentially reach the $4,000 per month income target in roughly 10 years. That's about 7 years faster than the REIT strategy and nearly 17 years faster than the Dividend Aristocrat approach.
Of course, every strategy involves trade-offs. Covered call ETFs provide exceptional income, but their long-term price growth may lag behind traditional equity investments during strong bull markets.
This is why many investors eventually combine multiple approaches. Some assets focus on growth and stability, while others prioritize immediate cash flow. In the end, all 3 strategies lead to the same destination: a portfolio capable of generating $4,000 per month in dividend income. The real difference lies in the timeline and the level of risk each investor is comfortable accepting along the way. Financial independence isn't built overnight, but with patience, discipline, and the right strategy, even small daily investments can grow into an income stream that completely changes how you live your life.